Welcome everyone to a new update, and today we'll be covering everything you need to know about the background of the current macroeconomics and the current recession. But before we're going to continue, make sure to subscribe to this YouTube channel beneath and like this YouTube update if you enjoyed the content. Last week we have posted the first two videos on YouTube and we were live on Friday too. Next week I'm expecting to be live on Monday and Wednesday as well. If you like what we do, our trade ladder and premium membership can be tested for 1 week for free. The links in the description gives you all the information you need to join for free. Finally, FTX is our core sponsor on this YouTube channel and we're able to do a big giveaway. We're giving away 3 one-year memberships to our platform 8 Global, where I'm sharing my trading portfolio, trade IDs and more. In order to do that, you will have to sign up to FTX through the links beneath and you will be able to win those prizes. In today's video, we'll be covering some macroeconomic events. We'll be talking about the recession in the US, which is technically approved by the recent GDP data and ignored by the speech of Powell. Next, we'll be discussing the uncertainties in China, like the zero COVID policy and the slowdown of the economy. Finally, we'll be discussing the Russia-Ukraine conflict and its contribution to the energy supply crisis and the food shortage. After that, we'll be finishing off with an outlook and a discussion of the central bank's policies in recent years. But let's first dive into the recession topic. Months of stock market volatility, surging inflation and rising interest rates have left many investors wondering if a recession is coming. The US GDP was announced to be negative for Q2, which means that the US is in a recession officially. The country is technically in a recession when the value of all goods and services produced, which is GDP, during a particular period falls for 2 consecutive quarters. The first quarter of this year, as you can see in the graphic, was minus 1.6% and now it's minus 0.9%. There has been much talk about a recession, job losses, hunger and the stock market plummeting in the first half of the year due to overlapping crises assailing the global economy. Although the pandemic seems to be the main cause, it is mostly related to the decisions of economic policymakers to manage the economy. Let's have a look at the situation in China, as it's a good example of how unexpected events can rise. In recent months, the economy has been teeming with mixed messages due to the pandemic, the conflict in Ukraine and looming uncertainties in China. It was reported that China's economy expanded by only 0.4% from April to June compared to last year. The forecast was 1%, while 4.8% growth was realized over the same period last year. The primary reason for the decrease in growth was lockdowns in big cities in China. The underperformance of China endangered the prospects of scores of countries that trade heavily with China, including the United States. As a result, the global economy has lost an important engine. As a result of the pandemic, China's economy has been slowed to an alarming degree, probably causing shortages of industrial goods while limiting international exports. China's zero-COVID policy has been accompanied by lockdowns that have generally constrained business and life. Now that we are facing such a massive strengthening in the US dollar, you could also question yourself why that is a good case. Remember, within the social media echo chamber, people are shouting that it's a good thing that the US dollar is showing strength recently, but that's not entirely the case. Of course, within Europe, the Russia-Ukraine conflict doesn't contribute to a strong euro, but the entire potential collapse of the Chinese financial system is the biggest hurdle to overcome for the global economy. In that case, September is going to be a massive month as a whole. It's going to be important for Europe to decide direction and to see whether gas and commodities are going to fall in prices. Also going to question whether the Euro-USD pair is going to be adjusted in value upwards. But more importantly, is China going to bail out companies to let the economy continue? The economy is slowing down heavily there, as we have just been discussing, and bailouts in real estate markets, as an example, should come, otherwise Lehman Brothers, remember Evergrande as the first example, might come. China has fixed this issue by solving it like the US has been doing that in 2008, but honestly, the entire situation in China is very much comparable to like the period in 2008. Recent statements on Evergrande is that they have failed to deliver the debt restructuring plan, as you can see. That's all coming together in coming months and might be even more critical than any other situation in the markets nowadays. Right now, September is going to be important on that case, as then China is going to come with information on their policy and whether they are bailing out companies as a whole or whether they'll tear down the entire market. China was not the only contributor, we also had to face the Russia-Ukraine war. The The spread of COVID-19 and the accompanying economic shock caused most of the challenges tearing at the global economy. Russia and Ukraine are critical to the world's food supply at this point, and the war has cut deeply into both Ukraine's production and its ability to export, which has reduced food, fertilizer and energy supplies. Because of the scarcity of products, prices have been increasing. As a result of Russia's offensive in Ukraine, the economic turmoil has intensified. Russia's oil and natural gas stockpiles have been restricted by international sanctions to force the country to relent. This has resulted in a surge in energy prices due to the disruption of global supplies. Since the invasion, crude oil prices rose nearly a third, though recent weeks have reversed the assumption that weaker economic growth will depress demand. The largest economy in Europe, which is Germany, relies on Russia for nearly a third of its natural gas. The sudden interruption of the major pipeline transporting gas from Russia to Germany raised fears that Germany might soon restrict energy consumption. The German industry would be chilled by supply chain problems and the loss of exports to China. According to economists, Germany would almost certainly enter a recession if it loses complete access to Russian gas. It's going to be a fun winter, I'd say, but now let's discuss the central bank policies. In order to prevent joblessness and bankruptcy, governments across the globe unleashed trillions of dollars in emergency spending. There's now a growing consensus among economists that they stimulated spending power too much, causing inflation, while the Fed delayed raising interest rates for too long. Aside from the temporary impacts of the commodity prices and the swift shock that reopening economies gave to supply chains, the increased amount of money being printed and released in the markets has been pushing inflation numbers higher and higher, as recently Europe and the US have reached numbers not seen in 50 years and the US peaked at 9.1%. You could also argue whether or not the growth of the stock market is real or whether or not it's due to the fact that governments have been printing a ton of free money. Let's continue with the unemployment rates. Trying to catch up, central banks have raised interest rates aggressively in recent months, fueling fears that they may set off a recession. In the American economy, there are a number of conflicting indicators that make it difficult to predict the severity of any slowdown. In July, the unemployment rate was at its lowest point in almost 50 years. However, the recession has been heightened by concerns about rising prices and a recent slowdown in consumer spending. As a result of weaker consumer spending, the International Monetary Fund cut its expectations for US economic growth for this year from 2.9 to 2.3%. This situation is even more complex because the traditional tools of central banking aren't built to handle it. It was difficult to balance protecting jobs and to curb inflation in simpler times. Prices are still rising worldwide due to war, which is thus far resistance to sanctions and diplomacy, coupled with all supply chain problems. The Fed and the ECB have no reason to pull that would compel Putin to act. Neither can they clear the backlog of container ships clogging ports from the United States to China. In wealthy nations, the central banks have tightened credit, causing investors to abandon developing countries where risks are way greater in favor of more secure investments like the US and Germany government bonds. You can check one of my videos for more information about this. Outflows of funds have pushed down the value of underdeveloped country currencies, forcing households and businesses to pay more for essential imports like food and fuel. For example, there is a big fuel crisis right now in Sri Lanka. In Europe, the ECB raised interest rates by 50 basis points while the expectation was 25. When an economy slides into recession, the central bank lowers interest rates to make credit more readily available, resulting in more borrowing, spending and employment. However, Europe is not only facing weak growth, but also soaring prices, which normally means raising interest rates. Increasing rates would support the euro, which has lost more than 10% of its value against the dollar this year, but would at the same time create further difficulty for the economy. Now we've got a decent grasp of the different factors that affect the current outlook. Let's discuss a potential short-term outlook on the markets. First of all, we've got the entire crash of currencies against the US dollar impacting markets and resulting into a case where everything except the US is seeing accelerated inflation taking place. A very simple example is the case that every commodity is being priced into US dollars, which means that fuel prices in Europe remain to be insanely high per liter, while in the meantime the Brent prices are dropping substantially since earlier this year, while in the meantime the euro has been losing 10 to 15% of its value against the US dollar. Therefore, it's important to look forward. Increasing rates is probably a short-term outcome of strengthening for the euro, but does that really help the actual issue of the entire global economy? That's up for debate. However, these weeks in August and September will be decisive whether or not markets are going to reverse. Recently, markets have been showing strength towards risk-off assets as the US dollar has been gaining strength and the yields have been compounding substantially on the government bonds of the US as well. This should be peaking relatively soon as such a strong US dollar is collapsing the entire financial system as a whole, so Powell and the Fed can keep up with their policy for a few reasons. If the US dollar remains as strong as it is right now, it will hurt the internal economy and therefore unemployment rates are going to be higher, but also loans and debt will become more expensive. What does that mean? Well, they simply mean that the policy of hiking interest rates has to get towards the end relatively soon, otherwise the system will be destroyed and therefore the money printing came as to be resumed to combat inflation as there's simply no other outcome in the current situation as the Fed didn't fix the issues in 2008 either. Expectations are that we will be having a 50 or 75 bips hike in September, which is currently expected to happen, but that's not the core of the event to keep an eye on. Going forward, the following topics are important to watch the coming month. First, you will have to face what China is going to do with bailing out the internal economy and real estate markets. If that's the case, then they will pull a Lehman Brothers 2008 case where everything is standing and staying alive and the music keeps on playing on the Titanic. Second, you will have to watch the yields on the government bonds as those might be topping out and the Euro USD expecting to be bottoming relatively soon as well, in which case a reversal might be happening. Third, you will have to watch PCE and CPI inflation data and Powell in their speech in September as that will be giving a strict guideline to the policy for coming months. Initially, Powell wanted to hike in Q4 still and then reverse the policy in 2025, but I'm expecting that we'll be finishing the hikes in September and going to QE from early 2023, as that's the only likely outcome to keep the momentum going in the economy. But what should you do? A quick investment thesis summary. What are the expectations based on the data that we have right now? Well, we've got the data which isn't looking great. We've also got commodities increasing rallying in the past year. Explicitly, gas is doing a massive rally and within Europe it's even crazier. However, commodities have been seeing this rally as most of them have been coming down substantially as well. Second, we've got a recession in the US, we've got strength on the US dollar with a run of 20% in less than a year, we've got yields running up swiftly overall in the US and Europe, and we've got a period of hikes in the US too, which is a certain policy to combat inflation. Coming to an investment thesis that you shouldn't be basing the past market into future-based investment decisions. Why? Well, we are getting towards a crossroad of decisions. The US can't keep up with their policy and will most likely reverse sooner than later as printing more money is probably the only outcome for fighting the inflation. Ultimately, the entire financial system is going to collapse and we'll guide you through it, but for now it seems reasonable to reverse the investment thesis. What does that actually mean and what can you do with the investment thesis at this point? Well, it seems to be that the entire world is expecting the indices to continue falling heavily, Bitcoin to drop to 6k and the dollar to continue strength. That's understandable as we have been witnessing a correction and crash across the markets. However, during the summer of 2021, the entire world was anticipating a continued rally of Bitcoin as well and a supercycle to start, while we've actually been dropping close to 80% since. In trading and investing, it doesn't make much sense to follow the general thesis, but to be different. Therefore, as a conclusion on this part, it makes sense to look for longs on the euro, to look for shorts on government bonds, to look for longs on crypto as that's probably the best case for a higher return, and also to look for potential longs on indices and gold. Let's round off this entire video with a general conclusion. After the pandemic, central banks started to raise interest rates to control inflation. However, the Russia-Ukraine war and supply chain crisis in China news blew up. This news triggered the energy and supply chain crisis, increasing inflation even more. Then it became harder to control inflation for central banks without causing a recession, and eventually this is exactly what happened. But was inflation actually controllable in the first place? Do we need a central bank? Considering all the economic structures of countries and the policies of their central banks, most economists expect further contraction in the coming quarters. Nevertheless, it is hard to measure the possible effects of a recession and how deep it can go. Morgan Stanley is more optimistic about the recession, while on the other hand, Vanguard is more pessimistic. We are in a recession with a high inflation environment. In that case, it will likely evolve into stagflation, which reverts to an economy experiencing a simultaneous increase in inflation and stagnation of economic output. However, we can't be sure if we are already priced in all bearish scenarios. During stagflationary periods, gold has been doing really well. Maybe this time it's going to be crypto. The further economic downturn can potentially cause a sell-off in stocks, in which crypto can be dragged down as well. All the markets have been in deep fear for months globally, and it would be wise to consider that everything is possible when the level of fear is so high, and be ready for all kinds of price movements. However, September is going to be a crucial time to watch with all the decisions to be made on global markets, which could cause a reversal in policy and therefore reversal in risk appetites across markets from investors. We'll be updating the content during the coming month and keep you updated on the economic outlooks and expectations so that you can match your investments with it. Thanks for watching. It has been fun making this video update on macroeconomic events. Make sure to hit that like button beneath. Also make sure to subscribe beneath here to the YouTube channel and stay tuned on the latest content. Finally, if you want to, sign up to FTX and be able to win one of our prizes of our platform. And if you want to check out our content for free, the newsletter and premium membership are your go-to place for 1 week. Stay calm and patient, and I'll see you again coming week in the live streams. Ciao!